Hello again, this is Josh Albayero with Ayugo, the creators of Ayugo Tax, the application that will change the way you file your taxes. Say goodbye to confusing applications and, more importantly, say goodbye to fake free and upgrades. This is episode 3 of Taxes Are Simple, and today I want to talk about a very important question that's on everyone's mind. How much in taxes am I supposed to pay? With the implementation of the Tax Cuts and Jobs Act bill, the tax brackets that are used to calculate your taxable income have changed, therefore creating a high level of confusion on how much taxes you are supposed to pay throughout the year. We are all about simplifying taxes, and we want you to understand that taxes are really simple, which is why we are bringing you this short explanation. Let's take a look at the tax rates prior to the law changing.
If you haven't seen this chart before, it's very simple to read. The rates went from 10% all the way to 39.6%, and you fell in one of these 3 categories: single filer, head of household, or married filing jointly. If you take a look at the 2018 rates, they still began at 10%, but instead of jumping all the way to 15%, they moved to 12%, 22%, 24%, and all the way to 37% for the higher earners. Married couples filing jointly still have the biggest advantage under these tax rates.
As you can see, the new tax rates are more favorable, which means that you should be able to take more money home. It's important to understand that we are only talking about the federal income tax withheld and not the Social Security and Medicare taxes, as those 2 tax rates were not affected by the law changes. If you are a W-2 employee, for the most part, you pay 6.2% of your gross income in Social Security taxes and 1.45% in Medicare taxes. These taxes are also known as FICA. Also, if you are self-employed or reporting as a sole proprietorship, you are subject to the 15.3% self-employed tax rate on top of your normal federal income tax rate. This 15.3% covers both the employee and the employer responsibility for the FICA tax. Stay tuned for a more detailed video in the future explaining taxes for self-employed taxpayers. Let's take a look at the current tax brackets one more time, and I will show you how your taxes are calculated using a gross income of $100,000 for a married couple filing jointly as an example. One of the common misconceptions about calculating your tax liability is that you simply need to identify your tax rate and then multiply that by your gross income to figure out how much tax you owe. If that were true, then we could look at the tax bracket chart, find that $100,000 falls under the 22% tax bracket, and therefore your tax liability would be $22,000. That is not correct. Fortunately, the tax bracket works proportionally, and each tax rate represents a chunk of income that will be taxed at a different rate. Let's take a look at the chart and figure out what the actual tax liability is using $100,000 gross income as an example.
The first $19,050 will be taxed at 10%, yielding you a liability of $1,950. The next $57,994 will be taxed at 12%. Yielding you a liability of $6,959.28. And the remaining $22,956 will be taxed at 22%, yielding you a liability of $5,050.32. If you add up these 3 amounts, it equals $100,000. At the end of the year, your total tax contribution was $13,959.60.
Now that you know how much taxes you pay, let's take a look at how much taxes you should have paid.
First, let's take a look at the adjusted gross income of $76,000. How do we come up with that amount? It's simple math. $100,000 in gross income minus your standard deduction of $24,000. $100,000 minus $24,000 equals $76,000. With the adjustment, your total tax liability at the end of the year is only $8,784. Therefore, creating an overpayment of $5,175.60, which will become your first part of your income tax refund.
As you can see, the first part of your refund comes from the simple equation of how much did you pay and how much you should have paid. If you overpaid, you get a refund. If you underpaid, you have to pay. And let's be clear, we have not included the credits yet. There are non-refundable credits and refundable credits, and we are not talking about that right now. So in a later episode, we will cover the refundable and non-refundable credits that can either help increase your refund or helps you pay for the tax liability that's calculated based on how much you paid throughout the year and how much you should have paid. If you found this episode helpful, stay tuned for the next episode. Remember, every Thursday, 8:30 p.m., 7:30 Central, we're here with Taxes Are Simple. Our purpose is to show you that you can do your own taxes without having to go to a tax preparer or having to pay TurboTax or H&R Block and upgrade. Taxes are simple. You're never going to like taxes, but you'll love Ayugo. We'll see you next time.